everyone, welcome back to the Daily Dive. Today we are joined by David Lesser of Power REIT. Hey David, welcome to the dive.
Hey there, how are you?
I'm great, thank you. How about yourself?
I'm doing really well. Can't complain. It's a new year, and here we go into 2021.
Okay, so let's start off with a question we ask most of our new guests. Could you give us the 2-minute elevator pitch for Power REIT?
Sure. So Power REIT is a small cap real estate investment trust. We are listed on the New York Stock Exchange. We're a sustainable real estate focus, and mid last year we pivoted to focus on greenhouses as an asset class. So we view that as a sustainable kind of structure to grow certain crops in. So far, we've done a number of transactions all around the cannabis cultivation, and the yields on those acquisitions are quite attractive to us as we see it on a risk-adjusted return basis. So we've been growing at a very, very fast pace over the course of the last year and a half since we announced that sort of pivot into that business focus. We had a great year last year, and we're really excited about our sort of prospects for 2021. We have a huge pipeline in front of us, and we have a program to raise some capital.
So at the moment, Power REIT doesn't have a large cash position. What is the plan to get more cash on the balance sheet to generate more deal flow?
Sure. So we recently announced a rights offering, and the concept of a rights offering is it's a non-dilutive way to raise capital. Essentially, all of our existing shareholders get the opportunity to participate in the offering. And because we feel like we're at an early stage, sort of a formative stage, we really view this as a unique opportunity or point in time in terms of our company and the growth trajectory. So we wanted to give that opportunity back to our existing investors. Having said that, based on a combination of the fact that we're a relatively small company combined with the very high yields we've been investing at, we see a lot of growth in front of us from deploying the capital from this rights offering. So it's almost like a circular concept. If we raise the money, the stock should advance quite nicely. But because the stock should advance nicely, we should raise the money. So for example, actually today we announced an acquisition. And based on that, we've given guidance of $2.35 of a run rate of FFO. That's before any new acquisitions. If we raise all of the capital from this rights offering and deploy it at yields, frankly, lower than we've been deploying at for some conservatism and add in some G&A for bringing on a team, we can get our FFO on a run rate basis, our FFO per share, to over $3 a share. And that's still very significant growth right in front of us. So this rights offering we think is quite powerful, and we think we can implement this relatively quickly.
Okay, so David, let's assume there's a descheduling event at some point in the future. Suddenly, many of these issuers have access to a lot more capital. How does this impact Power REIT?
Sure. So look, near term, I think we're going to continue to have a nice trajectory with or without a descheduling event, but I do think there's going to be some runway before that even happens. Understand that the value of our assets goes up quite a bit if there is a descheduling event. So because we've invested in greenhouses, which should be the low-cost producer at the end of the day of high-quality plant material, we feel we have a sustainable business model that can compete long-term. And frankly, the value of our assets will go up in that event. But our hope, frankly, is for some further runway, and that's what we expect, to continue to deploy capital at what are very, very exciting yields for us right now.
Can you walk us through a typical deal structure for the REIT?
Sure. So the deals we've done, they're all basically with us owning the real estate. So anything that qualifies as real estate can fit into our bucket of what we will finance for a project. And then we lease that to our tenant operator. And the structure we've used, we think, is very well sort of thought out for the cannabis situation, in that we structured rental payments that actually return our entire investment over the first 3 years after a short deferred rent period. And the point of that is essentially to both de-risk the asset from our standpoint by returning our capital, but then in exchange for that, we've provided our tenant a somewhat lower ongoing long-term rental stream. And the point of that is we think it makes for a sustainable business model from their side and frankly from our side. By having that lower long-term rental stream, if and when capital becomes more efficient, it will make it easier for our tenants to compete. And yet with this overall deal structure that we think is very attractive to both us and is a win-win for our tenants, it really sets us up for success, we believe. And so it works well with our tenants, but then from our company standpoint, We also, because we're getting that capital back, we also have additional capital that we don't have to go out and raise that we can then further deploy into new assets and continue to grow our cash flow and FFO per share.
How do you diligence the companies you choose to work with?
Sure. To some extent, as we've been doing our proof of concept, kind of the early acquisitions we've been doing, I'm really underwriting it more as a project finance story than necessarily a credit story, which you see a lot of sort of triple net lease operators focus on credit. We're really looking at a given project in a given state based on its ability to compete within that state. And again, with our deal structure where we pull back our capital on the front end of the lease payments, the rental payments, we think that the chance of success for them is enhanced. First of all, they know near term they have to underwrite to a pretty high rent to us, but then after that, they're kind of on easy street, if you will, and they've got these lower ongoing rent payments. So we're really underwriting their ability in the near term to make that important high rent payment, and then it gets easier and it's kind of downhill skiing from there.
How are you forecasting cannabis and the political landscape over the near to medium term?
Hard to say, obviously, what's going to happen. And I don't profess to be an expert in cannabis by any measure, but I think it's going to be something that will continue to evolve. I still think that it will evolve somewhat on a state-by-state basis for quite some time. And even if you had some legalization at the federal level, my sense is you may have states continuing to try to maintain control over elements of this business within their borders. And so therefore, I really feel like our strategy of owning the real estate, leasing it to quality operators who really are focused day in and day out on growing and cultivating in these facilities, we think that works in all environments, frankly.
Well, thank you so much for joining us on the show today, David.
Thank you. I enjoyed it.
And to our viewers at home, don't forget to click that subscribe button below, and we will see you next time on The Dive to go over some more small caps.